Record to cloud. All right. All right. Well, hello and welcome. My name is Robert Wolf, and I'm an asset coach and a tax strategist. The goal for this podcast is to help define what an asset coach and a tax strategist does by bringing various guests and partners of mine that help me to bring the most out of what business owners are looking for, which is cash flow. So how do we increase cash flow? That really is the main thing that are on business owners' minds a lot of times. And there's different ways to increase cash flow. And so that's the idea of this podcast and the various people that I bring in to interview and just have a conversation. So you, the listener, the viewer, gets the opportunity to get information and make informed decisions and jot down questions that you may or may not have. Now, I want to be able to share various ways that we can do this by not necessarily selling products or services, but really by providing the value of information. So that being said, everything that's talked about here is just for educational purposes only. There is no advice being given. We are just two gentlemen. I'll introduce Brian Clark here in a second. Two gentlemen just having a conversation and just trying to understand how Brian and what he offers to prospective clients and how that fits in with my prospective clients, and maybe it'll fit for you, maybe it won't. But again, this is just for educational purposes only. So welcome, Brian.
Thank you, Bob. Good to be here. Good morning.
Sure. Good morning. Good morning. So why don't we just start off something really simple? Just tell us a little bit about yourself.
Sure. I have been in the financial services business coming up on, over 19 years. Pretty soon it'll be 2 decades, and started off life as an aerospace engineer. So I've always kind of come at things with a bit of an analytical approach. And for the last handful of years, I've really been focused on alternative investments, and I currently serve as the Director of Business Development for Reliant Life Shares based in Sherman Oaks, California. And, we offer a unique alternative asset class that most people are not familiar with.
Right. Yes, you do. And we'll get into that a little bit more. So it's interesting that you talk about aerospace. One of the things I found, I've been in the business for 18 years, and so you got 1 year seniority over me.
Matter of months.
Exactly. But one of the things that would frustrate and drive me crazy about this industry, and when I say this industry, I'm talking about finance, real estate, banking, you name it. You just take it all and just glob it into one big pile, is that a lot of it is really emotionally driven. And we're taught and trained as new advisors, if you will, as new professionals, how to drive that emotional connection with the prospect into a buying decision. And that would drive me nuts. And yes, it's an emotional decision, but the emotion should really be because of the excitement or the understanding of what actions I'm taking as a consumer. And one of the best example I always use is car buying, right? Car buying, it's emotionally driven, man. And whoever walks away from a car dealership thinks that they got one over on the car dealership. Well, it's like Vegas, right? It's not a nonprofit business.
Yep. They do okay.
Yeah, absolutely. And so one of the things that you said that really is intriguing to me is from a scientific perspective, for me, it's let's let the numbers speak for themselves. Let's allow the numbers. My opinion, I have opinions, you have opinions, everybody has opinions, and that's somewhat the problem, is because a lot of times those opinions are what drive the emotions. So one of the things I enjoy working with you, Brian, our conversations, is that a lot of it is numbers driven. And because in the reality is we're talking about dollars, and dollars are numbers. And how it fits with somebody is a different story. We'll get into that a little bit later as well. So I appreciate you sharing a little bit about yourself. So you said something that I think was intriguing for the viewer, is you used the term alternative investment. Give me an idea or a brief explanation of what that means.
Well, most people own what I call the usual suspects in their investment portfolios. They have exposure to equities or stocks. They may have some fixed income, bonds, and they probably hold some real estate. If they own a home, maybe they own more real estate than that. And then a lot of people kind of stop there. They might branch out and invest internationally and think that is providing some non-correlation or some zig when our market gets zag, and that used to be true. But in the last several years, you can turn on CNBC World on your cable or satellite provider, and as you go to bed, you can watch what the Asian markets are doing. You can wake up early and watch what the European markets are doing, and then guess what? Our markets either led the way or are following. And so going international doesn't really provide that diversification that it used to. So people look to things like commodities, currency plays, precious metals, oil, those kinds of things. But all those things still can go up and down. A lot of people think that, oh gosh, gold is great, but in the last decade, we've had periods of time where gold, was off by half, and nobody wants to put $1 million in gold and wake up and have $500,000 worth of gold. And so, the ideal alternative investment should have little to no correlation to the other major investments that you hold as your primary holdings, the stocks, the real estate, et cetera. And ideally, you don't want to have to sacrifice performance potential to get that non-correlation. So very few things are uncorrelated and stay uncorrelated when things get rocky, like we saw, during the meltdown of, 07, 08, where real estate and stocks, kind of got tied together and dragged a lot of things down with them. An ideal alternative investment would be immune to that, but it's hard to find that non-correlation. And we believe, at Reliant Life Shares, we found, a good alternative for that. And we're trying to bring that, which historically has been used for large institutional investors. We're trying to bring that investment to the individual investor. And what we're talking about is, something known as life settlement investing. And, we can get into what that is, but Warren Buffett was one of the early players to the space. I've got an article reporting he still, through Berkshire Hathaway, invests up to $600 million annually in it. I've got articles showing that Blackstone, one of the big players out there, has been buying billions of dollars of this asset class in recent years. New Zealand's National Pension Fund, for example, picked up about 150 million of it. So the big smart money has been going there as we enter, a 10-year stretch here of a bull market, right? We can't expect this market to just go up for the rest of our lives without any hiccups along the way. It might. Now, I'm not a prognosticator of that, but I just think that anytime you're starting to set records for length of time, bull market, a decade long, there's geopolitical concerns on the rise. We're still in a low interest rate environment. And, stock and real estate, I'm not sure represents the same bargains that it did, 5-10 years ago.
Yeah, and that's true, and it's as a common consumer, if you will, it's difficult to. I mean, how do you Google this, right? How do you Google something you don't even know exists? And that's really how and why my business model has existed. Is I try to act as a CFO for my clients and looking for unique situations. And because of my business model, I've been able to meet some amazing people, whether it's on LinkedIn or you and I met through a mutual colleague and relationship. And it's as you start talking about what you do, you start getting introduced more and more, and opportunities arise. And who wins in these types of situations is the consumer. And that's the idea thing here, is that we need to make sure that we're focused on the consumer. And one of the things that we as an industry always talk about are investments. And I like to actually kind of keep it more basic than that. And Robert Kiyosaki, I think, has the best, the author of Rich Dad Poor Dad, has the best kind of definition of what an asset is. And his definition of an asset is basically something that puts money into your pocket. And we usually use the term investment in replacing of assets. And I think some of it has to do with my own personal opinion. I'll throw that in here. I know I'm a numbers guy, but I'll throw my personal opinion in here. I think sometimes our language is hijacked by certain industries to create a bias and somewhat of a directive motivation for you and I as consumers to buy something. And so I think the word retirement, I think the word investment, these are all things that are, in my opinion, are driving people to make certain emotional decisions again. Versus what you're talking about here is we're talking about alternative investments. We're talking about different asset classes that exist that the big guys, right? You use some big terms like Warren Buffett, right? Known as one of the most sophisticated, and not necessarily sophisticated as in he's unique in the way he approaches investments. Is actually just the opposite. He's very simplistic when he approaches an investment or a company, but sophisticated in the sense that he's smart. He knows what he's done, and he's consistently shown the ability to increase value. And that's, I think, what we are consumers are looking for. So you had used, you're talking about a term called life settlement. You had used that in your explanation. So let's take a step back and give me an explanation of what is a life settlement.
Sure. A life settlement is simply the term that's used in the industry to define when a person who owns a life insurance policy no longer needs it, no longer wants it, or no longer can afford it. And we're talking permanent life insurance. Typically, we're not talking term. Sometimes people that have what's known as convertible term policies can convert it and sell it simultaneously to what's called a permanent life insurance policy, like universal life is primarily what we're using. And there's reasons for that versus variable universal life or index universal life or whole life. But at the end of the day, if you find yourself older and less healthy than you were when you bought the policy, and you find yourself in a situation where you no longer really need the policy, maybe the person you were going to leave that money to predeceased you, or there's been a divorce, or it was purchased as key person coverage for business, and that business is no longer in existence. Here you are sitting on a life insurance policy. Maybe you bought it for estate tax planning purposes, and the limits on that have gone up in recent years significantly. And so you're asking yourself, why am I continuing to pay premiums to leave money to surrender value is? But most people are unaware of the third option, and that is to sell it to an investment group. And when you do that, the Wharton Business School, for example, found that on average, you got 3 to 5 times more than your cash surrender value. So if you've got $1 million policy, let's say you're 80 years old, you've decided that for whatever reason you no longer need one or can afford this, maybe you've got $50,000 of cash value and you're getting ready to cash it in, and all of a sudden your someone in your life, your life insurance agent, your financial advisor tells you, hey, you know what, you're not as healthy or young as you were when that policy was issued to you. An investor group might pay you a lot more than $50,000 for that. So before you cash it back in and surrender it back to the insurance company for that 50, what if I could go out and get you $200,000 for that? That could be meaningful to that 80-year-old. So that is what a life settlement transaction is, some of the reasons why they're done. Now, on the other end of it, why would a Warren Buffett or a Blackstone or our firm or our investors, be interested in this? Well, we paid more than the cash surrender value to buy the policy, and we have to pay the premiums until the policy matures and the insured passes away. But the investor becomes the owner and beneficiary of that policy. And again, we said in my example, it was $1 million policy, and you got $200,000 for it paid to the insured. Well, that leaves $800,000 of margin to pay for those premiums. And it's a complex process in determining the value of that policy to come up with that $200,000 number in my example. But at the end of the day, it's a matter of that, there's a margin in there that's left for the investor, and it can be profitable because the payouts are coming from some of the biggest, oldest, strongest companies in the world, United States life insurance companies. And it's not a matter of if it's going to pay out, it's a matter of when. Because as Franklin said, the two certain things in life are death and taxes. And so, there's no getting out of this alive, I guess, is what the other way to put that. And so that's one of the reasons why, investors have appreciated this asset class. The other is the non-correlation. The fact that when that insured passes away has nothing to do with what the stock market did today, or what the value of your home is today, or what the Fed does with interest rates, or what the president tweets, or whatever the case may be, right? It's unaffected. They're going to pass when they're going to pass. And the underwriting that goes in to figure out how long they're going to live so that we can value this asset as best we can. That's, a fairly well understood process. I mean, insurance companies, if they weren't good at that, wouldn't have their names on big buildings and stadiums and the like.
That's right.
And then,
right. Well,
finally, the return. I just want to mention the return has also been attractive. If you can get market-like returns without the market volatility, the London Business School did a study and concluded that on a large portfolio of life settlements, that the expected rate of return was north of 12% annualized. So, whether it ends up being a solid single-digit number or a mid-teen number, somewhere in that range, hopefully. And again, it always could be worse, it always could be better, but that's a pretty strong performance without having to take the same volatility ride that sometimes the stock market and other markets give us.
Yeah, no, I appreciate that. This is an interesting area, and the reason why I find this an interesting area, because for myself, when I first heard about this, I'm like, oh, man, and some of our listeners may be thinking the same thing. This is a little bit morbid, right? We're waiting for somebody, or we're betting on somebody to die. And what was interesting as I was going through my due diligence and learning about this area and seeing if it makes sense for my current clients and or future clients, I realized, you know what? As an insurance professional, when I do offer insurance as an asset class, which is what you've brought up numerous times, that this is an asset class, Warren Buffett and all these guys would not be spending all this money and putting all this money into this asset class if it wasn't an asset class. But what I found was interesting was that even if the insured, the client who owned the policy, could pay the premiums, no matter what, the contract is doing what it's supposed to do. It's a life insurance contract. It's supposed to pay out when the person passes away. So there's no exchange other than the person who's really purchasing or who's paying the premium. It's going from the individual per se to an investor, but the contract itself is still functioning the way it's supposed to be. The obligation to the insurance company is still functioning as it's supposed to. They're still fulfilling their end of the contract, and the person paying the premium is still fulfilling that part of the contract. So you can't have a contract without two parties. Who wins in this is the person who originally had the contract, the individual, right? Let's call him Jim. Jim had this contract. You had mentioned that let's say he can't pay for it anymore, right? Or let's just say he sold his business and it was key man coverage or a buy-sell agreement, right? And he sold his business and the coverage was no longer needed. And so what does he do with it? Well, he could walk away, whether an advisor or not suggested that, he could walk away and lose out on all that money that he put into it. Or he can go into a relationship like in a life settlement situation, get those dollars back, get value back from his asset that he's held on for so many years, walk away with money in his pocket, and guess what? The contract is still doing what it's supposed to be doing. Now, who's I guess, from my own little mind, and I'm kind of regurgitating or kind of summarizing what you explained to let people know how I went through this process in my mind. Then I realized, okay, so if someone's willing to buy this asset, this life insurance policy, then there must be something in there, right? There must be a value there. And what would be the value? The value would be the difference between what they paid the individual, Jim, for example, and what the death benefit on the contract is and what they pay in premium. So it's no different than any other investment or any other asset that they buy. They figure out all the figures, they figure out all the numbers. If the numbers work out to get that 12%, 7%, if you get 7% with no volatility and something that's not correlated to use your explanation earlier, why not have that as an opportunity? So in my own little pea brain, that's kind of the process I went through and said, no, this isn't morbid at all. This is actually beneficial to all parties involved. And assuming it goes the way it's supposed to. And of course, there's some situations where it couldn't, and we'll discuss that a little bit in down the road here in a second. So now we know what life settlements are. So help me to understand, what does this mean for you guys, for Reliant Life Shares? So do you guys Yeah, I guess I'll just give you the mic. Explain how you guys are involved in this situation.
Sure. Reliant was formed with the idea that the individual investor really doesn't have a good way to access this asset class of life settlements. And, why leave it just to the big players to profit from this? And as you pointed out, it really can be a win-win-win scenario. If anyone doesn't like this, that's the insurance companies, because if you didn't know this was an option and you paid into a policy for a bunch of years only to throw it in the trash, the insurance company took money for years and never had to pay anything out. So they have not exactly gone around and promoted this as an option for people. But once people know about it, like you said, it's not a morbid way to make money, because if you think about it, that senior that in my example got $200,000 versus $50,000, boy, that, to me, getting only 50 would be morbid. Whereas if they get more money than their other options and the investors can profit, that's what Reliant does. So the way we go about it is we sift through a lot of different policies, trying to find the ones we believe are going to be good investments. Then it's a bidding process. We bid on those policies, and we might look at 100 and decide to bid on a handful and win one of them. And we like that policy. When we get it, we don't keep it on our books, and that's important as far as providing investor protection. We place it in trust at a very large old bank out of Kansas City called UMB. It was the old United Missouri Bank. They are one of the largest paying agents in the country for muni bonds, and they serve as our escrow agent and third-party trustee. And each policy is held in its own trust. And then what we do is we open up investment on a fractional basis to our investors for those policies. And so what they end up owning is parts of the trust based on how much they invest and how much they buy of each policy held in those trusts. They own that trust, and they reap the rewards of the death benefit when it happens. And UMB pays out everybody along the way what they're supposed to get, and is involved in that process. So that is basically what we do, because we recognize most people, if they have a few $1 million invested, well, gosh, do they want to take half of that or 3/4 of that to buy just one policy? And so the amount of funds it would take to do this for most people wouldn't work. So we could buy a $5 million policy or a $10 million policy, but offer up people slices of it for as little as $5,000 each. Now it becomes bite size, not dissimilar from a real estate investment trust, right? If you had, half a dozen office buildings that you would like to invest in and own, well, do you have the wherewithal, the knowledge, the time to go find those office buildings and pay for them and own them? Well, probably not. But what you can do is pool your money with others, and you end up kind of owning a piece of those, handful of office buildings. And so this is very similar. It's buying pieces of life insurance policy death benefits, and then it's a waiting game, and it's a passive investment. When you own a rental property, you might get a call at 2 a.m. to have somebody, maybe yourself, go fix the toilet, right? This is a lot easier. You just invest and wait and let nature take its course. And in the meantime, that the insured that sold the policy got more money than they otherwise were going to with their other options. And so that, makes this, honestly, rather than a morbid way to invest, actually socially responsible, because, if that senior has less money, maybe that's the difference between, going into a facility or having in-home care. I mean, it's that kind of decision sometimes that has to be made. And if the funds are there, thanks to maybe a life settlement, if that makes sense for that person, then that's a win for them, hopefully a win for our investors.
Yeah. Well, you brought up a couple points. The first point I'm gonna focus on here really quickly is I was talking to a couple other life settlement professionals that are in not in the fractional shares. I think you guys are one of the few that are doing the fractional shares. They are in the normal life settlement market, and one of the gentlemen who's been in it for ages, and he said, he's all, Bob, you want to know something? Regulatory bodies are actually looking at advisors, financial planners, CPAs, people who have a financial responsibility to do fiduciary advice to their clients. they're actually looking at how they handle old policies. And he told me about a couple cases where advisors had gotten sued because they did not use this as an option for the client. They suggest either they cash it out or, you know, one of the other actions that could be available other than trying to go to the life settlement market. And as that's starting to take shape, to your point, this is a socially responsible action that is occurring. We're caring for those who have done financially responsible situations by getting the policy in the first place, right? For whatever reason, that life insurance was the result or was going to be a responsible decision if they were going to pass away while having the policy. They won the life game. They did not pass away. They did not get a payout, but now they're in a financial situation or a different stage where they could use a payout. So I thought that was interesting from an advisor's perspective as a fiduciary. This is extremely important way of communicating and trying to educate our clients. The other thing you mentioned was, and I'm glad you mentioned it, was real estate investment trust. And it's funny because right before you said that, I wrote down crowdfunding, mutual funds, and stock ownership. And all of those are examples of what you just explained of what you guys do, where, you know, yeah, Warren Buffett may go buy an entire company, or he may buy few million shares of Coca-Cola or whatever the case may be. He's a fractional share owner of that company, right? And so we do it all the time. Crowdfunding is becoming a popular trendy term now of real estate investing, right? To where we can, you know, put a bunch of money into this pot with all these other people and buy real estate. Okay, it's just the real estate version of mutual funds. Syndicates. On the real estate side, or even hedge fund managers or venture capitalists that go out and buy businesses as a whole, and I'm an investor in that. Those are all examples, and I'm bringing this up because these are all things that maybe the person who's watching this has heard of those. And so trying to share how this asset class really is acting like other asset classes. Right. This what you guys aren't doing is not abnormal. It's normal. It's just there's not a lot of people doing it. Is that correct?
Correct. I would say that it's nothing a whole lot different than what you described. It's just the missing element for most people is the knowledge that a life insurance policy can be bought and sold after it's been issued. And it's kind of interesting. That, by the way, goes all the way back to a Supreme Court ruling in 1911. The first time it came up, it went all the way to the Supreme Court, and Justice Oliver Wendell Holmes ruled that you can reassign, sell, barter, trade your life insurance policy. It's yours. It doesn't belong to the insurance company. It doesn't belong to to anyone else. And so, just like you could at the time, 1911, gosh, I don't know, sell your tractor, sell your horse. At that time, you can sell your life insurance policy. So there is good, Supreme Court coverage, if you will, for that fact. And that's the missing fact that most people don't understand. But once you understand that, and you understand kind of where the policies are coming from and why people might be motivated to sell one, it's something that, when you get trained on how to offer people life insurance as a professional, they don't really cover anything beyond once the person's bought it. They don't get around to informing. And so informing them that this is an option down the road and it may fit in a few cases. And so, it's a daily challenge for us to really educate and get the word out that, hey, this is something that you can invest in. Here's why you might want to consider it. And luckily here in California, there's a unique law on the books that allows us to be doing what we're doing in the sense of a good regulatory framework. Senate Bill 1837 was passed back in the year 2000. And it regulates this, very nicely. It says who can invest in it, who can offer it, and everything that has to be done in the disclosure. And we like that. It's clear, cut and dry. So that's why we do business in California only, because of that law and that regulation. And, in terms of who can buy this, I do have to say that it is defined in the law. Section 25102Q of the California Department of Business Oversight, for those that they want to go read that if they're having trouble sleeping. But it's laid out in there, and that's really what gives the option, and a person needs to be qualified as per the law, and they define that as having $250,000 of net worth, not counting your house, your car, and your home furnishings. And so if you are qualified, but not fully accredited, so think $1 million of net worth beyond your house, you are limited to 10%, which I think is good. You know, somebody that has $500,000 probably shouldn't have more than 50,000 in this asset class. You know, we're not out here saying don't invest in all that other stuff. We're just saying, hey,
right.
do more like the big players do, like the big smart money does, and put in a shock absorber, put in a hedge to your other bets. And that's the function this serves. And a 5 or 10% slice, I think, you know, is appropriate. You know, if a person is accredited, they're free to invest more than that if they want. But I like that built into the law. That way, you know, a person isn't tempted to take their last 50,000 and put it into this. That, you know, that's going to take some time to pay out, right? I mean, it's not something where you're going to get your money tomorrow. Likely, could happen, but it's not likely. As far as when the insureds pass and when the payouts happen. So liquidity and longevity risk are two things that people definitely need to consider if they are California and they are financially qualified and they want to look into this, and, you know, contact you, you know, to get in touch with us, however that works. We definitely, you know, are there to answer all the questions, and I think folks will be interested and pleased with the level of disclosure they see on each policy before they ever sign on the dotted line and decide to invest. And we give our investors a lot of freedom and to build their own portfolio of individual policies.
Yeah. So as you were talking, one of the things that popped in my head was individuals who have a situation where they're a power of attorney in a situation of a family member, right? Let's say dad, let's use the same name, Jim. Jim's gonna be popular today. So Jim, who has this policy, he put this policy in place, has now become frail or has become whatever, but he had this policy in place because his own personal motivation, he wanted to care for his family. But now he's in a certain situation where he may have one of his children as a power of attorney who's caring for him, who's, you know, paying his bills, doing the various things, sees this and goes, oh, this is just an expense, we can't afford this. And then they get rid of this, not knowing that this is actually an asset that could be very beneficial, not to just them, but to Jim. And so I think that's what's important about this podcast here. What I'm trying to do is provide this education and having you on here, which I appreciate greatly, because this is information that is extremely valuable from a dollar and cents perspective for people who don't even know, again, what to Google, right? If I can Google a question mark, but what do I put before the question mark?
Right. So, and, you know, if you don't know about something, right, it's hard to get educated on it. So if anyone's watching or listening to this, you now know more than, I'd say, 95% of the people out there. And I would include a lot of financial advisors in that. Because Absolutely. Most financial advisors end up working for a firm that's ultimately owned by a life insurance company, or perhaps, you know, say deep in bed with life insurance companies distributing a lot of their products, they aren't, you know, offering this to their clients. So you're not going to hear this from a lot of the mainstream financial advisors, and that is because they don't want to upset the insurance companies, who would frankly rather, in most cases, people not know that this is an option and throw those policies in the trash. And they call that their coveted lapse ratio. They count on a certain percentage of people, and it's a high percentage of people, pay into a policy and never reap the benefits. So on the occasion where it makes sense for the individual that owns the insurance policy to sell it, and it's a decision. You know, the other analogy I'd like to use, going back to real estate to some degree, is when you do a reverse mortgage, you're basically making the decision that it's worth more to you to have money in your hand now than to leave equity to someone, you know, once you're passed. Here, if it's worth more to you to get more money in your pocket now than it is to leave a death benefit on an insurance policy to someone else who, again, may or may not even be around anymore. You know, you mentioned Jim, right? My father's name is Jim. My mother passed away some years ago, and I'm an only child. So if I, you know, drive this afternoon and on the way home get whacked and die, how motivated would he be to keep paying into a life insurance policy that he has, right? You know, my mom's not there,
Right.
I'm not there. Maybe
Yeah.
he'd look to his university that he went to, but I know my dad, having to pay those bills might not make as much sense to him. So if someone like a beneficiary, says, hey, mom, dad, don't sell that, I'm going to pay the premiums, then those never hit the secondary market. Those don't make sense to be sold. So it's only the ones where their option is throw in the trash or cash it in. And once you've reached that point, you should explore the life settlement option. And you can help, folks out there if they know someone who's got a policy that they may not want or need or can afford anymore. You can help them with that. And then you can help investors, on our side of the coin, participate by owning pieces of other people's life insurance who have sold them.
Yeah. Yeah, no, that's interesting. I appreciate you bringing that up. So we've talked about really all the exciting things about life settlement. if this could be an exciting part of the conversation, and I'm a nerd in that sense, that I do see this as exciting because this is information I think that is so valuable to people from a dollar and cents, like we've talked about numerous times already, and I don't want to beat the dead horse here, but this is exciting because this is information that is readily available to the average person based on this SB 1837 here in the state of California. We talk bad about California except for the weather, but we talk bad about California from so many different ways, and there are actually quite a few laws and quite a few statutes that the state has that no other state has that are beneficial to people, and this is one of those. So let's take all the exciting part away, and someone can get their money, and investors can put money into buy a fractional share. The contract fulfills its obligation. The individual Jim passes away. The insurance policy pays out, and the investors get their return. But what happens if Jim doesn't die? He lives longer than actuarially, or lives longer than the initial studies and the underwriting went through. What happens then?
Great question, and you're absolutely right. Up to now, it's been what we've been talking about all sounds rainbows and unicorns, right? But there is risk to any investment, and if you are ever told about an investment that has double-digit annual return potential and windfall potential like this one does, there are risks, right? Risk and reward are always tied together, and a lot of folks have not understood that, and we're all tempted to hear a great story and think we found something that's just wonderful, but when someone tells you, oh yeah, you're going to make double-digit returns and there's no risk, you need to be very wary and run the other way. Yeah. And so there are risks, and you hit on the primary one, which is longevity risk. The insured, when they go to sell their policy, they have to agree to turn over all their medical records. And what happens to those medical records is they go to underwriting laboratories, and they have methodologies where they look and they see how old the person is, and were they ever a smoker, are they male, female, where do they live, and they have these methodologies where they try and figure out how long that person has to live. Very similar to what an insurance company does when you buy insurance, right? If you have a terminal illness and are going to pass away in 5 minutes, an insurance company is not going to issue a policy, right? But this process of reviewing those medical records then allows them to come up with a life expectancy. And Reliance model I like because they don't just rely on one of these estimations. They get at least 3 for every policy, and they don't use the shortest one and they don't use the longest one, but they do use the median one. And so by doing that, we're not, what we're trying to do is contain that risk variable as much as possible. But you're absolutely right. Some policies will mature before that date. So let's just take an example. 80-year-old, they turn over the medical records and they have some health issues, and that's accounted for in the methodology of the underwriters. And let's say one of the 3 estimations comes out at 4 years, another comes out at 5 years, and another is out at 7 years. Well, we'll price and illustrate off the 5-year estimation. And if the person lives to that point or passes before that point, it's as simple as the amount you put in plus your total return, and it's as simple as that. However, to your point about longevity risk, if the insured outlives that 5 years with our model, additional premiums do need to be paid. And it's not that that's the end of the world if there's, some of those. You obviously don't want to see, though, every policy you buy go twice as long or longer than expected, because at that point you are, going to have some principal at risk likely. But by buying multiple policies, you try and hope that that won't happen to all of them. So if one of them does go long and the person was expected to make it 5 years, but they surprise and make it 10 or 11 or 12 years, okay, you might break even on that one and lose money. But if another one was expected to go 5 years and the insured passes away in 2 or 3 years, well, you might make a 20 or 30% annualized rate of return on that one. And so, it tends to be, kind of a balancing effect of short maturities and long maturities. And as you look at what I would call the risk reward profile of this investment, you'll see that early maturities benefit the investor more than late maturities hurt them. But, I can't sit here and say that all these people won't live longer than expected. But again, the underwriting process, our methodology of using 3 different estimations, we try and, get as close as we can. But you absolutely, we cannot sit here and say that people are not going to live long, because some will.
Yeah, no, I appreciate that. And, and I think it's important, especially from an educational perspective, that people get the understanding of both sides, because you are risk and reward. It's like the old teeter-totters in the parks, and they don't have teeter-totters, I don't think, in parks anymore. But when we were kids, we had teeter-totters, and that's the equation of risk-reward a lot of times. And depending on I think both can be controlled depending on your upfront due diligence. And based on our previous conversations to this and looking at things and client situations, there's a lot of due diligence, because you're right. We're dealing with people's monies. You're a fiduciary of all these investors' dollars. And so you're held to a higher standard to be a good fiduciary, do your due diligence, make sure that the odds are in the benefit of our investors, and that's important. So I think that's extremely valuable because you and I couldn't do it, just the two of us, right? We couldn't look at somebody's life policy and say, oh, okay, well, Jim, we'll buy it, and
we'd be
the first time we've ever done it.
Yeah, we'd be taking a shot in the dark, and so it is an extensive process. We have a lot of checklist items that we look into before we ever decide to bid on a policy. One of the major things we have to look for is something called STOLI. Is the policy a STOLI policy? Now, we're not talking the vodka. STOLI is what it stands for, and it stands for Stranger Originated Life Insurance, or Stranger Owned Life Insurance. And one of the things that must be in place when you get a life insurance policy put on your own life is the person that's buying it needs to have an insurable interest in your life. So there either needs to be a family relationship or a business relationship. If you just walk up to a random stranger on the street and buy life insurance on their life and you own it, that's not allowed, because you have no insurable interest in their life or death. And that is held up in courts as something that insurance companies don't have to pay out the death benefit on. And of course, we can't have that. And so we have to go and make sure that there was insurable interest at the time, make sure that the beneficiaries sign off, make sure that the person that sold it was in sound mental capacity. All these things have to be covered before we ever even decide to bid on a policy. And I think that's important.
Yeah, no, I agree. And, and let me make sure, I guess you can consider it the elephant in the room or whatever, but let me make sure that the people viewing this, anytime we're talking about people's, not just their financial situation, but we're also talking about their health situation, we've got laws and regulations as professionals, licensed professionals like you and I are, that we have to have privacy protection. There's a confidentiality that's associated with this. So that's extremely important during this entire process for people to understand, is that there is that privacy. It's still upheld on both sides of the equation, right? On both sides of the transaction. Is that correct?
Absolutely. We have to be HIPAA compliant with all those medical records, for example, and the information about the insured. Whenever I'm doing a presentation or seminar and we get to this part of the topic, there's always, one wise guy in the room that says, hey, if I buy this policy, am I going to get the name and address of the insured? And it's like, no, whatever you're trying to make some dark humor about is no, you're going to know everything else about the insured, but you certainly won't know who they are. And you're absolutely right.
Yeah.
That's all very protected, just as, we keep our investor, information protected. So it's good to know. It's one of the things that, has to be done as part of the process.
Yeah, it's interesting because, especially with social media and technology now, it's becoming more important to be able to give referrals, or testimonies is what we use it a lot of times. And I can't tell you how many times where I'll meet with somebody, a new prospect, we'll have a conversation, I'll share with them what I do, how I can be able to help them, and the first thing they want to say is, oh, can you give me some names of your clients? Well, no, I can't. Just like I would never give your name to a client, anybody else. No. This is the protection of people's information has become so important. The irony of it is that most of our stuff's online, which is, it's encrypted here and there, but then we always hear about these large hacks that occur, right? So is that more protected than what we're doing now, right? But I don't share any of that information. I don't need a client bad enough to use another client to get that, right? There should be a dialogue between the two of us. If there's questions and concerns, and bring them up. And so that's why I think it's very valuable that we've had this conversation. And anybody that's watching this, if you have questions and you want to have conversations, and you have, I have a scenario, or I have a situation, or Uncle Jim. or some kind of situation you're interested, feel free to reach out to me. I'll make the connection. We'll jump online, and or if you're local here, and we'll have a coffee or lunch or something, and discuss the situation with Brian and myself. But Brian, as time's winding down, we've talked about quite a bit. I mean, the hours just like zip by. And what else should somebody watching this know? What questions, what did we not talk about that you think that somebody should probably be aware of, or have an understanding of before they take whatever next step there is?
Well, I think, again, if an investor already has plenty exposure to stocks and real estate and other things, they might consider, this as a true diversifier. Because if you've already got, 2 million of various stocks, do you really need another 100,000 of the same mutual funds or ETFs that are going to own the same stocks that you already own? And if the market goes down 30, 40% in a matter of weeks, like it could, how are you going to feel if it all goes down? Whereas if you've got a slice in this, at least that's going to be a shock absorber or a hedge. And so, everyone's situation is different. I certainly can't sit here and say everybody should invest in life settlements, but I can say that it's an option to look at once you've already got kind of the usual suspects taken care of. And if you want to avoid another incident like we had in 07, 08, where a lot of the stuff you owned went down at the same time, then this is something to consider. And this is long-term money. This is probably 5 to 15-year money. It is worth noting that you can use both cash as well as qualified funds like IRA dollars or Roth IRA dollars. And depending on your tax situation and the advice from your tax advisor, we don't give tax or legal advice, of course, I've got to say that. But at the end of the day, if it makes sense for your tax bracket to use those IRA dollars or those Roth IRA dollars instead of cash to make this investment, that is an option. And we use the services of entities known as self-directed IRA custodians. And those companies exist to allow people to invest in alternative investments. And early on, you mentioned something about, the verbiage we use. I've heard alternative investments also called complementary investments. And I think for some people, the word alternative, they think, oh man, that sounds something I shouldn't be involved in. I want what everyone else has. Well, the big players, in addition to having good timing with their decisions, they're also using strategies that people don't know about. And the idea is that this complements what else you're doing. So if a complementary asset class sounds better to you than alternative asset class, by all means, let's call it that. And, I do think that helps people get familiar and comfortable. And then once they have an understanding of the insurance industry and what happens to policies that people don't, aren't able to keep or don't want to keep. When they understand that, then they see that, hey, this is a good way to potentially invest for a slice. This is meant for a 5 or 10% slice. And if you've got the time horizon and the risk tolerance and the information we disclose about all the policies, I think people will get where they need to be to make it a sound decision, again, with the advice of their advisor as well.
Yeah, it's interesting because at least in my educational process, when I have a client or a prospect and we're going through the process of reviewing their situation, looking at various strategies that are available, I always like to just share, hey, here's a conceptual thought of X and whatever that strategy is. So like in your guys' situation, I'll just say, hey, there's this complementary investment, alternative investment that is available, and it kind of works like this, right? So I'll just kind of give them just a conceptual idea of how it works. But you know what? I really don't know if it's going to work for your situation until we start really looking at the numbers a little bit harder and see if it makes sense with everything else. And usually that's the conversation I have pretty much with every single strategy we implement, even if it's something as basic as we're readjusting or reallocating your existing investments. Right? It does not matter until the numbers are ran, until everything is correlated together, everything. So if they're a business owner, we got to look at the business. It's got to work with their retirement assets, got to work with their real estate assets. It's got to work with, everything has to work in unison. And so as an asset coach and tax strategist, that's what we try to do. And so with Brian's group, and what we try to do and bring it with the life settlement shares is to also insert that. If you look at a pie, you guys are a piece of pie, right? Not the whole pie. And I would imagine that if someone came to you and said, hey, Brian, I've got this great client. They have about $500,000 in their IRA money. Let's use that as an example. And I think this would be great for them. And then probably the first question you would ask is, well, is that $500,000 everything they have? Oh, yeah, this would be wonderful for them. Really conservative. The first thing, what would you say in that situation?
Well, I'd say that, they do financially qualify. They could consider this, but, maybe a $25,000 investment or a $50,000 investment would be what makes sense depending on their situation, their age, how far away they are from having to take required minimum distributions if it's not a Roth and it's a regular IRA. Do they have a good enough understanding of what else they're invested in? Do they have the liquidity that they need to provide them money in case, the car breaks or there's something needed in life, and you don't want to have tied that money up in something that you can't access. So you need money to provide that liquidity. So those are some of the questions that we ask. And that's why, when you asked about, or when you mentioned having to really understand a person's situation and look at the numbers, when people find out, and you've probably had this happen as well, that I'm in the financial services business, they'll say, oh, hey, what should I invest in? And this is somebody maybe I met at a car wash, right? And and they get frustrated that I can't give them a simple answer of the hot thing to invest in, right? It's like that question, if someone's going to give you sound advice, they're going to have to ask you a lot of questions and go through that process. Yeah. It's so worth doing rather than just investing based on what some guy at the car wash told you to invest in. And so that due diligence process, the fiduciary responsibility, whether someone is a fiduciary or just, does everything a fiduciary does, I think you're better off than if someone's just, telling you what to invest in because they're going to profit from it. And that's not the idea, right? We only want clients where it makes sense for them. And once you, as their advisor, help them come to that conclusion, we're there to help fill that hole and provide that shock absorber if it makes sense.
Nice. Well, I appreciate you investing this time with us, Brian. I think this has been very valuable for me. So hopefully it's valuable for whoever is watching this as well. If not, again, this was very valuable for me.
Well, I'm glad to hear that.
So, but it's interesting. Nobody wakes up in the morning and goes, boy, I really feel like learning about life insurance and life settlements today.
Right.
It doesn't happen.
Like I said, it's an education process. Our phone doesn't exactly ring off the hook. Although with the internet now, I will say that more investors that look at the 10-year bull market run, the longest in history we've had, they look at the real estate values, they look at some of the geopolitical risks that they perceive, whether that be the China trade, war we've got going on right now, the North Korea, Iran, whatever the situation may be, there'll be some trigger, there'll be something that causes these markets to take a dip, maybe a dive. And so a lot of people are finding us on the internet because they are doing the research of, gosh, what can I do to help myself? Other than go hide in cash where I earn no money and lose out to inflation. So you can be both too aggressive and you can be both too conservative. And, again, I know what you do for your clients is you help them find that right path, that middle ground for them.
Yeah. It's and it's not easy. It's art and science, but but everything that has value and worth doesn't just happen right away. It does take a time and some process. So I appreciate it again, Brian. So if you're watching this and you have more questions that you jotted down, or you went back and you rewatched this to jot down some more questions, please do so. We highly encourage it. Questions are fantastic because it gives us a guide of what information we need to give you and help you out with, but also more importantly, to make sure you have that comfort level and that understanding to make a good decision. So as an asset coach and a tax strategist, that's our whole focus, is to provide the education, the information, almost like a Barnes & Noble shelf of investments and business, right? If you were to take all those books and all that information and aggregate that into your mind, what would that look like? And so that's what we try to do in our business at Terra Firma Business and Financial Consultants. And so why we call ourselves an asset coach and a tax strategist. So feel free to give us a call, send us an email, reach out to us. You have our information on the link that was provided with this podcast. And if you have more questions for Brian and you'd like to have that conversation, again, reach out to us and we'll be able to make that connection. So thanks again. We greatly appreciate your time and look forward to hopefully the next conversation. So thank you very much for spending time with us.
Thank you.
All right.